Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we'll discuss estate planning, end of an era for Warren Buffett. We'll also take a look at Irrevocable Life Insurance Trust and venture on over to the Plan Solutions Incorporated Office Bulletin Board. Mr. Armour, Happy New Year to you. This is our first recording of the new year, so good to see you as always.
Yeah, you too. Yep, new year, lots of work to get done. So yeah, trying to, work, and make sure we're all caught up going into tax season.
Yes, sir. Speaking of, I had just received my digital tax planner, so something we should make the those listening that are clients of Plan Solutions that, hey, check your email because that's coming out so you can get yourself organized.
Yep. We're trying to get people everything they need way ahead of time. Obviously, it'll be a little while before some of the tax documents are coming in, but at least people can start planning ahead.
Absolutely. All right. Well, let's dive right into estate planning. The new year is a good time to set goals to accomplish. We talk about that all the time, setting goals, including financial ones. So it's beneficial to take a look at creating or updating an estate plan. But you brought up something really pertinent here in the second paragraph, is that people don't realize whether you create one or not, an estate plan is done for you.
Yeah, exactly. So what a lot of people don't realize is that if you don't create your own plan, then there's basically a default plan that's set up in state law, right? And it differs from different states, but it may not be the right plan for you. Everyone's situation is unique, and that default estate plan that their state created and usually in the probate code, it might not only be right, it might be totally wrong, right? And so that's why it is important to, think these things through and create your own plan that fits your situation. And as you said, the new year can be a great time to kind of, take stock of some of these things. In fact, the inspiration from this came from, I thought about it and thought it's probably time that my wife and I update our estate plan. It's been a while. There's been some changes. Obviously, the kids are at a different, stage in life, different things to be thinking about. So yeah, it's as with a lot of these things that nobody really likes to think about, I think, most of the time, but it is, along with financial planning, retirement planning, all of these other areas. I mean, this is, an important aspect of financial planning.
Absolutely. Yeah. And, as outlaid here, probate, I mean, it can take months, years to complete and it sometimes be very costly, but it's not the only option. Of course, you can avoid probate and set up your own estate plan.
Yeah, that's the other piece. Probate is basically a process that goes through the courts of, determining the person's estate plan and helping to implement it. And with a lot of the court schedules, it can take a long time. In many states, there's mandatory fees, which can be pretty substantial, especially for a large estate. But if you set up your own estate plan, you can typically do a private estate administration, which, generally involves setting up a trust that serves as the primary estate management document that, lays out the decedent's wishes. And as long as the bulk of the assets are registered in the name of the trust or have some type of beneficiary designation, you can typically avoid probate altogether, and therefore, reduce the time that it takes, significantly reduce the cost. And for some people, it may be important that it's a private process. If you go through the courts, a lot of things can become public record, and people may not want that, right? They may want they have their own plan and they don't want it to be out there on a court website or something where someone can go access it.
Yeah, well, and with that said, is that advantage of setting and having your own estate plan, to your point, being private too. It also limits maybe those that can, I don't know what the proper term is, make a claim that they are owed in some way, shape, or form, which I would assume delays the process.
Yeah, settling the estate, and making sure all the claims are paid. You can have a process where you go through the courts and they certify, okay, everybody that's come forth has been paid, all of the assets transfer liability free. But you can also do that through the private processes as long as you meet certain deadlines and requirements and notices, where basically creditors would have to come forward and make claims, or it's too late if they don't meet those deadlines.
What about situations in which certain assets maybe can't be registered in the name of the trust? Is this where it's vital to have a will as well?
Right. Yeah. So there's typically three ways that the assets would be transferred. One is the trust. That's typically, accounts that are not retirement, insurance, things like that. You'd have in the name of your trust, especially, real assets like real estate being really important. And the trust can be the primary tool for that. Then you're going to have assets that can have beneficiary designations. So, typically retirement plans, insurance, so even some other types of accounts where you can set up beneficiaries that would take precedent. So that would determine those beneficiary designations would determine who gets that. But then there's a lot of things that, maybe you can't put a beneficiary designation, and you maybe don't have titled in the name of your trust, right? I mean, personal property is a great example. What do you do with furniture, collectibles, things like that? And that's where a will would come in the context of a broader estate plan. You'd often see what they call a pour over will, which basically says, when I die, everything that's not in my trust, put it in my trust. So that's a way that you can then use the trust as the main administration tool for all of those assets that maybe you can't register into the name of the trust ahead of time. And as long as the total value of those assets is below the probate threshold, you can still avoid probate. So typically you want the really valuable assets in the trust, and understand that maybe some of the other things that aren't going to add up to that much money can, be administered with the will that then would make them part of the trust. And then you'd follow the instructions of the trust.
So is that usually items such as family heirlooms, maybe if we're talking about photographs where you can't really necessarily put an assessment on that value, and that value tends to be more of an emotional one and such?
Exactly. Yeah. And like I said, like furniture, personal property. I mean, if you think of the value that would have at a yard sale, or, if it's being sold at like Goodwill or something, it's probably not going to add up to a lot, being that it's used and there's not a big market for it. But in theory, it does have some value. And so you kind of use the will as a catch-all to capture all of those items.
Yeah. Well, when we think of estate planning, I know for me initially it was always thinking, end of life, when I have passed away, what will go where to whom. But you point out as well, and we have talked about this, an important part of it is if there is incapacitation.
Right. That's the thing that people often forget, right? They think, well, why do I have to worry about an estate plan, right? By the time this becomes an issue, I'll be dead. It's not my problem. Well, yes and no. But at the same time, what if you become incapacitated and you can't make decisions for yourself? That's also an area where an estate plan will kick in. And, that is something that will affect you. You may not be entirely aware of what's going on, but it will affect your quality of life. So, partly the trust can do that. Assets in the trust will have a provision for incapacity as to who will become in charge of those assets and administer them. But a comprehensive estate plan will also typically have a financial power of attorney. And that lays out, who can pay the bills, file the tax returns, all of those other things that if you can't do it yourself, then it creates a legal framework where someone else may step in and do it, and typically without having to go to court and get something like a conservatorship or something like that, which again can be a very time consuming and costly process. So you can avoid those time delays and costs by planning ahead.
Well, where do retirement accounts generally fall under, and how is that usually assessed? And that is that under that financial power of attorney, or does that something where it depends upon how you've written out the estate plan and maybe designate an individual and so on? So,
Yes, yeah, retirement accounts typically fall under the power of attorney. Most retirement accounts cannot be registered into the name of a trust.
mm,
They have to be registered to the name of the individual. If you were to shift it into the trust, it would become all taxable at that point, right?
right.
So you have to keep those separate in an individual name. And since they can't come under the umbrella of the trust, the financial power of attorney, if drafted properly, would appoint someone that could then be in charge of managing those accounts.
So what about we've talked about the financial side, but what about when it comes to that medical decision making, if an individual becomes incapacitated?
Right. Yeah. In the case of incapacity, that's usually the two things. Who's going to handle the money, right? And make sure the bills are paid and the person's needs are taken care of. And then who's going to make those medical decisions? Because if they now can't make those decisions for themselves, who do they trust to make those decisions, and what instructions have they left behind?
Mm.
And so that's where a medical power of attorney, or sometimes called a medical directive, where that would come into place, where you're able to lay out what your wishes are, what decisions you would want made on your behalf if you can't make them, and then assign an individual to, in essence, use substituted judgment, where they take the instructions, but also there's lots of situations that could come up that you didn't anticipate, right? That you didn't have instructions on how those should be handled, and they can use substituted judgment. In other words, thinking, okay, what would you have wanted, right? What do they think you would have wanted in that situation, and make those decisions accordingly.
Yeah. Yeah. It can definitely be a very complex process, but one that's vital to have planned and laid out. And I think it would definitely alleviates a lot of the stress upon loved ones.
Yeah, and a lot of people, they say, "Oh, I'm busy, I can't get to it." The estate plan process might take a little while, cost some money, and so it's easy to put off. But what they don't realize is a little bit of time and money spent now to make sure all of these things are in order can save a lot of time and money down the road. For the people that are responsible for, dealing with your incapacity, or dealing with your death. So it is really a worthwhile investment.
Yes, sir. Anything else you want to add before we move to our next topic?
Well, some people might be thinking, well, I have an estate plan, but I'm not sure if it's still valid or if it still fits my situation, and so that's a case where we're not attorneys, but we can review an estate plan and give people a summary of, okay, this is what it says, right? Does this still reflect your goals? And if it does, great. If not, then, maybe it is time for you to update your plan as well.
Yeah. All right. Well, let's jump in here. I know this is a gentleman that actually you put on my radar. Boy, it's 20. No, how old are we? 30 something years ago. Warren Buffett. It's in and of an era for Warren Buffett. He stepped down at Berkshire Hathaway, which was something I never thought I would see occur, but kind of honoring his legacy, and even a similar. I don't know if lineage is the right word, but you had family lineage that grew up in and around the same area as Mr. Buffett.
Yeah, this is kind of my homage to Warren Buffett, who stepped down as the head of Berkshire Hathaway, the company that he founded many, many decades ago. And really just a reflection on one of the greatest investors of all time, who I think, did it the right way, and set a real good example for people that are interested in finance.
Yeah, agreed. And my two biggest takeaways from things that I've read on about him over the year was really that pay yourself first mentality that he had, and living still really moderate. I remember something saying where somebody interviewed him about what does he eat for breakfast, and it was still like his $7, $6 McDonald's breakfast sandwich, coffee, and a hash brown or something like that. That was like his splurge, so to speak.
That's right. Yeah, you may not want to take dietary advice from him. He was known for obviously Berkshire Hathaway. One of their biggest holdings was Coca, the Coca-Cola company, and so he was known for his affinity for cherry Coke. Which you can't find too many places. In fact, there was a story about he was having a meeting in New York City, and they asked what he would like to drink, and he said cherry Coke, and someone had to run 3 blocks to a CVS till they could find it. And then dessert came around and they asked what he'd like for dessert. And he said Dairy Queen, another company that Berkshire Hathaway invested in for many years. And they looked and they said, I'm sorry, sir, the nearest one's on Long Island. There isn't one on the entire island of Manhattan. So he decided to do without dessert. But yeah, someone who really, I think, just reflected those Midwest values. He grew up in Omaha, Nebraska, which my dad's side of the family is from Omaha. I think even before Warren Buffett was a household name because of his investment success nationally, he was definitely a household name in my household just because of the ties to Nebraska and people being more aware of the success that he was having early on. And what I find fascinating, I think he really proved that coming back to Omaha after college and setting up his company there, it proved that being far from Wall Street not isn't necessarily a hindrance. In fact, it could be a benefit. His reputation for avoiding a lot of the financial manias and follies that other companies fell for, I think maybe was because he was an independent thinker, but also just the distance from the groupthink on Wall Street. That really ended up being a competitive advantage for him.
Yeah, and what I've appreciated as when I had received the financial review and just kind of dug into that little more research to your point, I think he showed a prime example that we can think that success story is you got to be on Wall Street or to your point or anything, but he just really proved that wise investing, which takes time, anyone can achieve financial prosperity, no matter what your income rate is. There is a way to invest, plan for the future, retirement, and so on.
Yeah, and he had a very simple, common sense way of discussing investing that I think made it accessible to a lot of people. Didn't need the overcomplicated investment strategies and things that a lot of people try to sell as a way of justifying really high fees, right? And he's saying you don't need that. And his success proved it. I mean, during his 69 years of running Berkshire Hathaway, his cumulative return was 5.5 million% over his career. And I think one that just demonstrated the success of his investment strategy, but two, it showed the benefit of longevity and thinking long term. It's very interesting that trying to remember the exact numbers, but a statistic on, like 90% of his wealth, or maybe it was even more than that, has accumulated since his 65th birthday.
Huh.
Right. So it took a lot of years to build up to a large amount, but then the compounding of those returns by him continuing to invest, reinvest, continuing to work, it really showed how the compounding over time is the big factor in a lot of cases in growing wealth and achieving those just outstanding rates of return that he did.
Yes, sir. Absolutely. All right, let's move along to Irrevocable Life Insurance Trust. Irrevocable Life Insurance Trust is an estate planning tool that is used to keep life insurance proceeds out of the deceased taxable estate with the goal of excluding it from estate taxes, which can be as high as 40% at the federal level. We've discussed that more in depth in the past. But why is irrevocable life insurance, putting that in the trust, why is this kind of a vital part? Almost tie back to what we talked about first at the start of the podcast.
Yeah, so this used to be a common estate planning strategy, really centered around avoiding estate taxes. It's becoming less and less common now because the estate tax exemption has increased so much.
Mm.
But what we're finding is some people still have some of these out there, right? From past periods where maybe it made more sense. And now they've kind of taken a back seat, but once established, you still need to maintain them, right? Even if they're not going to have the same benefit that they originally intended for. But in essence, the idea is you establish an irrevocable trust, right? So irrevocable can't be changed. It's outside of your estate because of that. It's no longer within your control. You then make gifts, which are deemed gifts to the beneficiaries of that trust. But if the beneficiaries choose not to take those gifts currently, the gift amount goes into the trust. The trust then purchases life insurance on the individual who set it up so that when they pass away, the life insurance will pay off and you'll have this big chunk of money that will be outside of their estate. So not subject to the estate taxes, which, as you said, could be as high as 40%. So it's in essence a way to pass on a fair amount of money outside of the estate to avoid the estate tax. Now that was important back when the estate tax, kicked in at estates valued over $1 million early in my career. But now the federal lifetime exemption is currently $15 million per individual. And with portability and some of the other, I mean, a married couple can both use that 15 million, so it gets up to 30 million.
Right.
So there's not a lot of estates that reach that limit and need this type of tool to try and get money outside of the estate. Now, who knows how things may change in the future? Maybe they will continue to be valuable or a more viable planning tool going forward. But the reminder here, the things that we're seeing is some people still have those irrevocable life insurance trusts that were set up years ago and implemented back when the estate tax exemption was much lower. So it was a viable strategy at the time. Doesn't look as attractive right now. But because that is an irrevocable trust, right? It's an irrevocable strategy. Those still need to be maintained, and the proper administration and compliance needs to be done because otherwise you could invalidate the strategy altogether.
Yeah. Yeah. Any other insight that we want to give around this for folks before we jump to the bulletin board?
Well, I think this falls into one of those just general areas of estate plan review, right?
Sure.
And say, okay, what does the estate plan look like? What things are kind of set in stone from decisions made in the past? What things are flexible? And is everything being done correctly?
Yes, sir. All right, let's dive on over to the Plan Solutions Incorporated office bulletin board. One item pinned up there. What do we got, good sir?
Well, it's what you just brought up, right? So the 2005 income tax packets are going out. A lot of them are going out digitally. Those that have requested paper copies, those are going out. So, anyone who would prefer a paper copy that gets a digital link, by all means, let us know and we can send it out. So hopefully it's an opportunity for people to start planning for the tax season and, start setting aside the different forms and things that come in to make sure they have everything in place. Annually, I like to remind people that sometimes tax forms will come in with other mailings. They can kind of get lost in there. A great example is if you get your monthly mortgage statement, right? Time to pay the mortgage. A lot of times they'll have the form 1098 that shows the mortgage interest paid from the prior year right behind it. If you just take it and file it away thinking that, it's just part of the original statement, might be more difficult to find that 1098 down the road. So this time of year, it's just really good advice to go through those mailings a little more carefully. Anything that looks like a tax form, set it aside. If you're not sure, set it aside, right? It's always better to have more information than to be missing things that we have to go try and track down later.
Yes, sir. And one thing too that I would like to add, and I'm noticing more, I've gotten a few already, is to your point, needing to request physical copies. I've gotten quite a few things already digitally, and that's been stated in there. Student loan that's still finishing up, things of that nature, some expenses from the years, some of my donations, that's all coming in digitally as well. So just throwing that in to keep in mind as well.
Great point. Great point. And it could be a good time to go through that, spam filter, right? Just some of those things sometimes once a year can get caught up in a spam filter. And so going through and checking and, making sure that there's not something important there.
Yes, sir. All right, Chase, anything else you want to add while we wrap up this edition of the Plan Solutions Incorporated podcast?
Just wish everyone a happy new year, and hopefully, the positive trends that we finished on in 2025 can continue through to 2026.
Yes, sir. Well, we thank you all for listening to the podcast or watching along on our YouTube channel, which is youtube.com/@plansolutions. Please go there and hit that subscribe button, and also share the podcast with others that you think will get value out of it. We don't do any external advertising, so please spread the word. And if you have yet to subscribe to the Personal Financial Review, the written content we discuss here, send Katie an email and get subscribed today. It's katie@plansolutions.com.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.